Another 1929 style market crash? Well, that may be what we're looking at. Hey guys, Britt here. Welcome to End Times Bible Prophecy. Now, we've talked about this a number of times, the ongoing financial crisis, economic crisis that's taking place. And I believe we will see this market crash, but typically market crashes play out over the course of months and years from peak to trough. I believe the 1929 crash took about 3 years for the Dow to lose 90%. Saw something similar in the dot-com bubble when that burst. We saw the NASDAQ decline 80%. That took place over a 2 to 3 year period. I believe we're going to see something similar here. However, could we see something like we saw in 1929 when that crash, what people remember it as beginning with, were 2 days known as Black Monday and Black Tuesday, where we saw the Dow Jones decline 23% in a 48-hour period. And that it destroyed a lot of people, bankrupted a lot of people at that time, even though we saw the market rebound a month later. And then it slowly, steadily went down over the course of years. I believe that the risk we could see a major 1 to 2 day crash of that magnitude is heightened right now for the next 2 to 3 weeks. We have a higher probability of seeing that. So we're going to look at why that is, because we're seeing some things beneath the surface start to break. So in this video, we're going to talk about what's going on, what do we see, what are the signs we see, the conditions in place that make this a more likely possibility. Then we're going to talk about what happens next, maybe what we can do about it, if anything. So guys, let's start right here. If you missed this came out on the Substack yesterday at brittgillette.substack.com. 5 signs we're in a global depression and it will be worse than the financial crisis. And this goes through what we're seeing play out in the global economy, not necessarily markets, but what's impacting the day-to-day inner working of the global economy, from the trade war that's taking place and what the impacts of that trade war are, as well as what we're seeing in the U.S. economy, the conditions that are in place there, as well as the Chinese economy, the German economy, and the Japanese economy. So we see all of these things taking place that point to depression. We are in a global depression. And again, we've been talking about this for 2.5 years probably. But guys, it's here. And I think we're seeing a lot of people around the world wake up to this reality that it's here. This came before the Trump tariffs. The Trump tariffs, if they remain in place, make it worse. If they aren't completely, even if they aren't completely resolved, or even if they are completely resolved today, well, we've still seen a lot of uncertainty. This depression is a depression. It's here to stay. And I don't know that we're going to see this resolved in the way that people think. We'll talk about that as we go through this. But what we're seeing is a depression, and the signs that we see in the marketplace confirm that. So let's take a look right here. This is from CNBC. It's crude oil. So again, we've talked about the global economy. There is a direct correlation between energy used and economic activity, and vice versa. If you see a bunch of economic activity, you see a lot of energy use. There are no countries that have a great booming economy and low energy use. And so oil, the price of oil, tells us a bit about what our expectations are for the global economy going forward. And look at this chart. While we've seen markets gyrating back and forth and up and down, oil has been straight down since the Trump tariff announcements. And so that tells us what we need to know about what the market expects for the global economy and global economic activity. They see far less demand for oil. So we've seen when oil was $72 before that announcement. Now it's at $56. That's about a 20% drop in the price of oil, just straight down. Look at this plummeting line that we see there. So that tells us global economy, the expectations are for a depression. We see the same thing in copper. While we see it up marginally today, as of right now when I'm recording this, it's, 1.47%. But look at where we were a couple of weeks ago, and then right before the Trump tariff announcements, it was at 5.04. So again, not quite 20%, but maybe a 15% drop, and that plummeted as well until we got to today. So copper, again, is something we would look to tell us about the health of the global economy, because copper is used in a whole bunch of things that are produced in the economy. So when we see demand for copper plummeting, we see demand for oil plummeting, that tells us we're seeing confirmation of lower economic activity. And really, these plummets that we see in these charts, to me, is telling us the market expects depressionary level slowdown. We also see this right here, again, down from the highs from earlier today, but this is the VIX. We pointed this out a couple of days ago. This is a measure of volatility in the markets. Prior to a few hours ago, this was probably mid-50s, which would put it higher than the heights or the depths, whatever you want to call it, of the pandemic market breakdowns that we saw in the pandemic shutdown of the economy. Really only exceeded on record by the depths of the great financial crisis. So this is telling us we're at crisis levels when it comes to the VIX, and this is a sign of an unfolding financial crisis. And so guys, this is telling us all of the things that we've been saying on this channel were coming. We're seeing these unfold right before our eyes. And one of the things you would expect to see, and I think one of the reasons you see these crisis levels, one of the things you would expect to see when you have a global depression, stocks going down, oil going down, copper going down, is you would expect to see a flight, what they call a flight to safety, or a move into U.S. Treasuries, where investors get a guaranteed return. Because again, the United States is the world's monopoly supplier of dollars. They can print dollars at will. So if you buy a U.S. Treasury that says, we'll pay you 5% to own this for the next year, 4%, whatever, you can feel pretty confident that they're going to pay you that. Now, doesn't mean that the purchasing power of those dollars will be what it is today, but there's no reason they wouldn't pay that, because they can simply print the dollars. So we would expect this flight to safety, where people are trying to avoid losing investments in oil and stocks and all these other things that we see in the investment world, and moving into, quote, the safety of U.S. Treasuries. But guys, that is not what we have seen. So here we have the 10-year U.S. Treasury. Again, this means people would lend dollars to the United States Treasury for 10 years, and they would be paid back a certain interest rate. Right now, that's 4.38%. We would expect that that would go down, and that's initially what we saw following the announcement of these tariffs. Let me move to a shorter chart. So here we saw this going down, and then now it's been nothing but straight up. And we see that across all the different maturities, whether it's 1 month to 30 years. Really, 1 month is the only thing that we do see going down, but we see rates going up across the board. What is going on? Well, what is going on is something is breaking. Something is unwinding. What is that? Well, we read a bit about that here in this article from MarketWatch. It says, here's the unsettling reason the world's most important market is getting hammered by Trump's tariffs. And it's not Trump's tariffs that are doing the hammering. Again, that You can call that the catalyst that led to this. I likened it to an earthquake. But guys, all of this is the result of years and years of terrible policies, bad decision making, and as we'll talk about, excess leverage that people should not have taken on. So it says, chaos in the U.S. stock market spread to the $28.6 trillion Treasury market on Monday. And one prominent Wall Street economist said hedge funds bailing out of a popular strategy might have been to blame. Apollo's Torsten Slok said a vicious unwinding of the so-called Treasury basis trade likely contributed to a 17 basis point spike in the 10-year yield on Monday. The move burned investors who had sought refuge in the bond market last week, because bond yields move inversely to prices. So what is going on? Well, we read this from Jim Bianco, this tweet he put out. This is from last night. The article we just read was from yesterday. He says, something has broken tonight in the bond market. We're seeing a disorderly liquidation. That means panic selling, that you have to sell. For whatever, you've taken out a loan from somebody, and now they're calling your loan, and you have no choice but to sell. That's what that means. If I had to guess, the basis trade is in full unwind. Since Friday's close to now, the 30-year Treasury is up 56 basis points. That's 0.56% in 3 trading days. The last time this yield rose this much in 3 days was January 7th, 1982, when the yield was 14%, meaning it was a much smaller move on a percentage basis than what we're seeing right now. So, in other words, this is unprecedented. This kind of historic move is caused by a forced liquidation, not human managers making decisions about the outlook for rates at midnight Eastern Standard Time. So, in other words, no one in their right mind would sell these. This is not the result of, well, we're looking ahead and we think this is the best thing for us, the best decision to do this. They have to do it. Because again, this is the refuge that people would often seek out. And I do think that they will seek it. We'll see these yields start to go down. We're going to see all of this reverse course in due time within, I don't know when, a few days, few weeks, maybe today. I have no idea. But that's going to cause its own problems, as we'll read about in a moment, because let's look at this to try to get a firmer understanding of this. So this is from the Kobayashi letter. It says the bond market just broke. In just 3 days, the 10-year Treasury surged 60 basis points, while the S&P 500 fell around 8%. This marks the largest 3-day increase since 1982 and one of the largest divergences in history. What happened? Well, the basis trade broke. More specifically, something broke last night. Between 7 p.m. and midnight Eastern Time, the 10-year note yield surged another 25 basis points. The 30-year jumped above 5% even as stock market futures collapsed. This is extremely unusual price action. Something broke. This puts the 10-year yield 60 basis points above levels when the Fed pivot began in September of last year. In a market that's pricing in a recession, and I would say pricing in depression, bond prices should be rising and yields, or the interest rates on those, should be falling. We are now seeing the exact opposite in one of the fastest moves in decades. There's one logical answer to what's happening here. The basis trade is being unwound. So what is it? Well, the basis trade is a strategy hedge funds use to arbitrage the small gaps between prices of cash treasuries and futures. So there's a few pennies to be made between the difference in these two things that they'll talk about here. And here's where this matters. and why we have a heightened conditions for a massive crash. This typically involves leverage of 100x, 100-fold. So imagine someone has $1 million to invest, and they take that to, I don't know who, Goldman and Sachs, and they say, we could make a lot more if we could invest 100 million instead of just $1 million. So they get a loan for $99 million. Right? That's what they're saying here. And then they invest the full 100 million, hoping it goes up, 1/10 of a percentage point, and then they'll pay off the $99 million loan and have all these massive outsized returns, assuming it works out the way they hope it will. It says the basis trade exploits the tiny difference called the basis between cash treasuries, meaning actual U.S. government bonds bought on the open market, and treasury futures, contracts to buy or sell treasuries at a future date. Futures often have slight price discrepancies with cash. If you're able to capitalize on these discrepancies, you're able to capture, quote, arbitrage. In other words, like I said, save a few pennies here and there, but if you can leverage up on that, you can magnify that into some big returns. However, as we are once again seeing now, this is not a risk-free strategy. No, it's not a risk-free strategy to be take on 100-fold leverage. Yeah, it's just not. In times of low volatility, hey, it's fantastic, it works out. But when volatility surges, which again is what we're seeing levels we have not seen since the Great Financial Crisis, since the depths of the Great Financial Crisis, it's detrimental to the trade. Current estimates show that the basis trade is massive and sits around $800 billion. I've heard as much as $2 trillion. The key point here is that these positions are highly leveraged long positions. When these levered positions are unwound, someone has to absorb the exogenous shock effects. In the short run, these positions are being absorbed by broker-dealers. The $800 billion basis trade reflects around 40% of the $2 trillion outstanding in prime brokerages. The issue is that broker-dealers themselves are capital constrained and cannot afford such a rapid move. So could we see some of these broker-dealers go bankrupt? We could see this could have a cascading effect through the entire global financial system. Simultaneously, the United States continues to issue record levels of treasuries to fund deficit spending. As the supply of U.S. treasuries grows, bond prices are falling further. This further stresses the long leg of the trade and repo funding because dealers have a limited balance sheet. So the Treasury is continuing to issue these things and the market can't absorb them because they're being sold off en masse. The basis trade in treasuries is similar in nature to the yen carry trade we saw unwind in August 2024, and we've talked about this recently as well, just last week. In March 2020, the basis trade collapsed and volatility spiked. During 2020, the Federal Reserve began buying $100 billion in treasuries per day in an effort to contain the collapse. So guys, we're seeing something similar unfold right now. And I would point out that, yes, I think this is going to end. Maybe it ends with the Federal Reserve intervening once again, as they did 5 years ago, and buying these treasuries to prevent these yields from going up. That could be what we see. I think we'll most certainly we'll see that if it comes down to it. But that poses a problem, right? Because as we talked about in Saturday's Substack video, The Trump tariffs were an earthquake, and that earthquake triggered a tsunami that has yet to hit shore. And that tsunami, well, is this, the yen carry trade. And we pointed out, if we see the US dollar, Japanese yen exchange rate, if we see that go beneath 145, that's probably going to create margin calls of its own. The problem we see now is we see treasury yields going up. We see Japanese government bond yields also going up, but they're going up much slower than these treasury yields that are being sold off. And some of what we're seeing is probably troubled Japanese banks selling the US treasuries in order to remain solvent. So we're seeing a lot of broken things in the market. We would expect to see, if we saw a greater divergence between interest rates in Japan and interest rates in the United States, which is what we're seeing right now, we would expect this number right here to be going up. We would expect that that would cause less problems. It wouldn't put this pressure to reverse the yen carry trade. But we're still seeing that. So what happens, guys, when treasuries have this reversal, and whether it's the Federal Reserve coming in and intervening and buying up these treasuries so that the yields don't explode and we have an even bigger problem? When those treasury yields start to come down and that differential between Japanese interest rates and US interest rates closes again, we're going to see a rapid unwinding of the yen carry trade on the back side of this. So guys, things are breaking all over the place. This could get this could very, very rapidly, we could see this unfold. And again, I will point to this article over and over from August of last year. It helps provide you with a roadmap to understand what's going on. We're going to see continued volatility as a result of this crisis. We're going to see, I think we're going to start to see we're going to start to see rumors in the next week or two hit the media about some troubled banks. May even hear about some bank failures. I don't think we're going to hear about massive bank failures just yet, but I don't know. And we never know when these bank runs will start to trigger. But again, these massive unrealized losses on bank balance sheets were because yields went up, which is what we're seeing right now. So that's making matters worse. We're on the verge of seeing this massive government central bank response. They're going to have to intervene if this continues much longer. And then I think a real crisis in the banking system and bank runs hits when we hear about the first bank bail-in. I don't know when that's going to be. We could still be months away from that at this point. But, and again, these steps, as I point out in the article, they're not necessarily sequential. You could see multiple of these happen at one time, and we're seeing stuff blow up right now. So guys, all of this is telling us this crisis is not gone away, regardless of what the stock market does from day to day, whether you see it go up or down. And I'm sure we're probably going to have some of the biggest up days in history in the next couple of weeks. Maybe today, maybe later this week, I don't know. That's typically what happens in these types of periods where you have a market crash. So we would expect to see that. But guys, beneath the surface, it's nothing but things blowing up. And there's a reason for that, and a reason why we have this heightened risk of a 1929 style crash. And the reason is because of what we just read. Some of these hedge funds or family offices or investment firms have taken on leverage of 100x, 100 times. They're borrowing $99 million and investing 100. And again, history should be a guide for what to expect. Pointed to this before. So this is a book about the Great Crash from 1929. And in it, I would point out, we read this sentence right here. It says, people were swarming to buy stocks on margin. And buying stocks on margin it's a fancy Wall Street way of saying you take out a loan in order to buy stocks. So, well, I want to buy 10 shares of that stock, but I can only afford one. Well, I'll borrow the cash to buy the other 9. And we saw a lot of that in the lead up to the 1929 crash, people buying on margin. It says, in other words, to have the increase in price without the cost of ownership, or I want to have my cake and eat it too, type philosophy. So we're seeing this type of leverage. And back in December, we did a video on the Substack where we talked about this article right here, because we're seeing 1929 styles of leverage in the system. And this was from December 3rd by Lance Roberts. We talked about this, and because one of the things you'll read about in the financial media is they'll say, this is not 1929. Margin levels are not what they were then. And that's true, but we see something different rolling out than just simply buying on margin. People are doing something different. It has to do with things like options. So here he says, one sign of leverage and speculation that we are watching are options. Options provide a leveraged way to bet on stock movements. And that's exactly what it is, guys. This is gambling. It's speculation. It is not investing. It's betting on price movement. That's gambling. Requiring relatively little capital for potentially outsized returns. In November, U.S. stock options volume hit nearly 70 million contracts on average per day. That is the second highest on record, and trading activity has doubled over the last 2 years. So look at this. Things were pretty much within this range until, the pandemic comes along and the central bank unleashes all of this cash liquidity. We saw 40% of all the dollars in existence printed between February 2020 and February 2022. Surprise, surprise, we saw inflation at the grocery store, but we also saw inflation in housing prices and in the stock market and everywhere else. And we saw that all of that liquidity go into these options that were levered up to try to enhance returns. People are gambling. And so look at this isn't going to show up in people borrowing on margin in those statistics, but it's essentially what they're doing. It says as long as the market rises, those bets, and again, that's what they are, will pay off handsomely. The problem is that leverage works excellently on the way up, but quickly turns into massive losses when markets decline. Options trading has become a focal point for modern speculation. The accessibility of trading platforms and low cost have made it easier than ever for retail investors to engage in speculative bets. Think about all these commercials we see on TV for sports betting. You can download this app and bet on your team. Well, people are doing the same thing with stocks and crypto coins, right? They're gambling. They're outright gambling from apps on their phone, sometimes levered up, borrowing in order to do that. And that's not going to turn out well. This goes on a little bit. It says, don't understand how to trade options? No problem, as Wall Street has got your back, or rather, your wallet. The newest speculation and leverage tool of choice is leveraged single stock exchange traded funds. These funds are designed to amplify the daily performance of a single stock. Remember, amplification goes in both ways. They were developed to meet investor demand for an easy-to-understand product. For example, Granite Shares NVDL offers 2 times exposure to NVIDIA and has seen soaring trading activity. while the ETF can double the returns of NVIDIA on any given day, it also doubles the losses. Such instruments are inherently risky, especially in volatile market conditions. Their popularity reflects an increasing appetite for speculative investments, which is a nice term for gambling, often at the expense of prudent, long-term decision-making, which is what the Bible would tell us to do. And so here we see how this had just ramped up in the months prior to now. Because this is 2023 over here, and we're seeing more and more people just speculating and gambling in the markets. He says, these trends are not unprecedented. Historically, periods of excess leverage and speculation have driven markets to dizzying heights before sharp corrections followed. Investors today must understand these dynamics, learn from history, and adopt strategies to safeguard their portfolios. So guys, this is why we have a heightened conditions for a Black Monday, Black Tuesday, 1929 style crash. Again, it wouldn't be the full crash all in a day, but a 20% plus crash in 48 hours is a big deal. It would scare a lot of investors. It's going to break a lot of things in the financial system, as we're already seeing happen right now. So this could get out of control very quickly. And especially given, well, people might say, well, why can't the Fed just come to the rescue? I think they're going to try. I think there's a difference here. I think the Trump administration is looking to crash markets. This is their policy. You might say, well, why would they do that? Is it some Build Back Better scheme? Well, not World Economic Forum Build Back Better. What they're trying to do is they're trying to unwind all this excessive leverage and speculation. They want to drive it out of the market. They want to drive away the inflation that's been eating away at people at the grocery store and everywhere else. They want to be able to refinance the national debt at lower rates than what we see today. Right now, it looks like this is working in opposite of what they want. I think we'll see a change in that soon as we see those rates start to come down and we see this flight into U.S. Treasuries, which I think is what they want. And so they're going to push things forward until that happens, because that's their end goal. The problem is, along the way, I don't know if they understand how excessive all of this leverage is and what it's going to do to the entire global financial system to do that. And so, yes, tough decisions have to be made, but decades and decades of policies can't be unraveled in a few days. If they do, you break a whole lot of things in the process. And once broken, it's going to be very hard to put those pieces back together again. And I don't think anyone in the world fully understands the extent of what we're dealing with when we go down that road, because we've talked about before, there's anywhere from 1 to 4 quadrillion with a Q, quadrillion dollars worth of derivatives in the global financial system. What happens when those start to break and we see a crisis in that market? We don't know. We don't know how bad this could get. So, that's why reading the comments from the last video where I asked about this, there were a few that stood out. One person asked, well, what does this mean for finance in Australia? Well, it means the same thing it means for everybody everywhere. We're in a global depression. And even if you don't have anything in the stock market, you may go, well, I don't have anything in the stock market. Why should I care? And that's probably true for a lot of people. In the United States, 88% of all the stocks in existence are held by the top 10%. That shows that wealth disparity. But that's all that's kept the world out of this depression, coming into being in this depression. What happens when the spending of that top 10% also dries up the way it has for the rest of us? Well, that has huge repercussions for the global economy. It means factories shut down, not as much needs to be produced, layoffs start to occur. All the things we saw during the Great Depression. So this is going to make things worse. In the same way where we talked about, well, if you don't have more than $250,000 in the bank, and that's insured, so what do you have to worry about? Well, you have to worry about, what about the business that you work for, or your neighbor works for, or your children work for, that has their payroll at that bank? And when the bank goes under, they lose that. Now the business has gone under, and they owe certain vendors who now won't be able to collect. And then they start to go under. That's called a deflationary spiral. This could rapidly blow out of control, this financial crisis. I don't know how long all of this will take, but this is why we have a heightened risk of seeing a major crash in markets in the weeks ahead. And guys, we again turn to that article. I'll pin a link at the top of the comments so that you can go review that, to walk through that process. It's the process that's going to take us from where we are today to a system that's indistinguishable in function and capability from the mark of the beast system. It's a system of central bank digital currencies. They're already rolling them out. Digital IDs, they're already rolling them out. Tokenized assets, they're already rolling them out. One of the other questions that popped up before is, what does this mean for mortgages? What does this mean for people who own their house outright, or for cars? Are they going to tokenize those assets? Yes, absolutely. Those are going to be the first things they want to tokenize. They want to tokenize everything they possibly can tokenize, but there are reasons financially for firms and governments to tokenize these things to drive down transaction costs. So the deed to your home or your mortgage would be tokenized. It can be divided up, right? So a mortgage could be divided up into an infinite number of different pieces and sold off. So there's money to be made, but there's also surveillance to be done by the government. So they're going to be pushing these things every aspect of our lives. And this tells us again how close we are to the tribulation period, because a system like this has never existed in the history of the world, and we're seeing it roll out right before our eyes. This financial crisis will give them the reason, the impetus to tell people, we need to do this. We have to. There's an urgency to roll all of this out. And if you don't go along, well, you know, we saw how in the last 5 years, if you didn't go along, there was a carrot stick approach taken to that, and to pushing people in the midst of a crisis to do things that clear-headed they otherwise would not do. And so, again, do the things that we've talked about before, as far as, you know, having a deep pantry. Don't take on 100-fold leverage and gamble in financial markets. Bad idea. Hopefully nobody out there is doing that, or trading these different options on an app on their phone, or whatever it may be. So if you're doing any of those things, I advise you to stop doing those things. That's a bad idea. But try to be as much out of debt as possible. You know, everybody's situation is different. Build a cash reserve. Again, be prepared for a bank holiday. God willing, I'm working on an article right now for this Saturday on how to go about preparing for a bank holiday and the things that we need to make sure are in place, because I think the odds are increasing that we're going to see that coming down the pipe as a result of this unfolding crisis and what we're seeing, because we're going to start seeing banks go under as a result of this. We're going to see major institutions fail just as we saw during the great financial crisis, where we saw Bear Stearns and Lehman Brothers and a bunch of big retail banks just go under. We're going to see the same thing here as well, maybe to a much greater degree, I believe. So we need to be as prepared as possible. The Bible tells us that the prudent foresee danger, take action, take precautions. So we need to be taking precautions for ourselves and those around us. And we need to be in the Word and focused on Jesus. There's no need to fear any of this, guys. God is in control. He's known all about these things. So if you have your eyes fixed on Jesus, remember, Jesus says, I give a peace that surpasses all understanding. The peace I give, the world cannot give. You can be an evangelist to others by your actions, not by it. You don't even have to say anything, but by the peace you have in the midst of this crisis as it comes, to those who have built their lives on the shifting sands of this world and are building kingdoms in this world. As they see those kingdoms falling down, yet they see you steadfast at peace in Christ, they'll say, I want that. Where can I get it? And then you have people asking you, share the gospel with me. So guys, that's the most important way we can be prepared, is we need to be preparing ourselves for the opportunities to share the gospel that are going to be coming in the days ahead. Those are opportunities you don't want to waste. They're opportunities that have eternal value, not any of the stuff in the markets that's here today, gone tomorrow. We want to build up and store up treasures in heaven, where rust does not destroy and moths don't eat. We have an opportunity to share the gospel and bring somebody to Jesus through our words and actions in the day ahead. So make sure you're preparing yourself for that. And God willing, I will see you on Friday. In the meantime, leave your comments below. Let me know what you think. Again, God willing, I will see you on Friday.